Story that we're tracking. Sources close to CNBC TV 18 tell us that DHFL, sources close to CNBC TV 18 and DHFL itself say that Blackstone is likely to pay the company around 2,500 crore rupees, this for Aadhaar, by about June 10. Lata Venkatesh joins in with the exclusive details. Some money coming in, Lata?
Yes, the source close to DHFL said that Blackstone will pay that 2,500 crore by Monday. And the logic is this: if you looked back at on May 8th was when the ad was put out that DHFL and Aadhaar have reached an agreement to buy that 100% subsidiary, and the two parties have to wait for 1 month before which the payment can be made for anyone to oppose it. And therefore June 8th becomes the last day, and therefore June 9th the payment comes, and this 1,150 crore which was to have been paid yesterday will be paid by Monday, which is why DHFL could confidently put out that press release that within a week they will make the payment.
All right, so hope the street takes some note of that and provides some bit of relief. But meanwhile, we also spoke with Rajesh Lee of Dimensions Corp, who says that while the default is disappointing, disappointing development, there are no other solutions to this crisis rather than a straight sale of DHFL. Listen in.
I think it's very disappointing because it was in the making. All these smoke signals were there that this company did zero business. It hasn't done disbursement for the last 60 days, was allowed to continue instead of being either forced to merge with somebody, to sell off, and taken a long-term position on this. This is like a slow death which is happening with the company, and the lenders will lose a lot of money. I think it's a straight sale of the company. I think there's no other solution to that, because I can't believe that after the Cobra Post expose and all the issues on corporate governance, any window of RBI or any bank can lend money to this company under this promoter. So I think it has to be someone to come in and just take over this company. But I think this is looking to be a slow death kind of a Jet Airways style, that what could be retrieved is now letting it go into the dumps.
All right, Ajay Srivastava disappointed, but says that there could be no other option rather than a straight stake sale coming in from the promoters. Lata, you're gathering some more on that as well?
Exactly. It appears that a stake sale will happen sooner rather than later, and we should not draw analogies with Jet. The Vadhavan's sources, again, the same sources said that they have been speaking with several private equity guys. For instance, Apollo, Lone Star and Cerberus. Nisha had reported that even earlier. An indicative term sheet is already there with the Vadhavans, and they are hoping to make it a binding term sheet within 3 to 4 weeks. Post that, of course, their stake, the Vadhavan stake, will come down. The source refused to say to how much, but he did indicate that management control will go away from the Vadhavans. There will be a management change, and therefore it looks like a sale could happen within the month.
All right, some money coming in, promoters selling, a sale could happen within a month.
The important point is that if there are new owners, like for instance Lone Star or Cerberus or Apollo, or a combination of them, then banks will be willing to bankroll, because these are deep-pocketed investors, and therefore they may come out of the crisis altogether.
All right, so definitely a development worth keeping an eye on. But Lata, you've also gathered some sources, you've also gathered some news from the sources at various rating agencies?
Yeah, what will be the position of the rating agencies on a loan which has not been paid on the due date but will be paid within 7 days? Can they not mark it to D? What we hear is that SEBI and RBI rules, or the country's rating rules, are very strict. 1 day default will be D. This grace period is a bilateral agreement between DHFL and whoever bought the debentures maybe, but the country's rating regulations will supersede some such a bilateral arrangement, so it will have to be marked, and they can't, because the payment is made, they can't bring it back to whatever BBB, which is the current rating, or which was the previous rating, immediately. The SEBI rules require that you have to give a curative period up to 3 months. I mean, they may not have to wait up to 3 months, but maybe you have to wait at least a month or two before they bring it back. So even when they bring it back, it may not be BBB, it may be B or C.
Right.
So, we should not expect, status quo ante to prevail, is what rating agency sources said. So NAV hit for mutual funds is still there. There may be a hope that, it will get corrected in a bit. If DHFL changes hands, then, you know, the NAV could be restored. But at the moment, the NAV hit is there.
All right, Lata, thanks a lot for that 360-degree view on DHFL. You spoke about the temporary liquidity coming in. You spoke about the imminent stake sale plan and what the rating agencies are doing. Now, request you to wear your RBI hat. And ahead of the RBI policy tomorrow, the data indicates that banks have lent over 86,000 crore rupees to the central bank, and this through reverse repo on Monday. Compare this to the month of May, where the banks had borrowed up to 1 lakh crore rupees. So does this mean that the government has begun spending, which is the money which was lying idle in its account, and the liquidity crisis perhaps has been abated?
Yeah, that is the logic is that government was not spending in April and May because you know, it wasn't in place, and therefore the you know, in the RBI press release there is an entry every day which says unspent government money that used to run into 70,000 crore, that fell to zero on June 3rd. And exactly on June 3rd, you know, again the RBI release on a daily basis tells you how much money net banks are taking from RBI and giving to RBI. All through the last many months and including May, banks were borrowing on a daily basis. The net borrowal amount would be between 50,000 crore and 1 lakh crore. And on June 2nd already we had seen the banks net giving to RBI because they had surplus cash. And on June 3rd they lent as much as 86,000 crore because there was a bond redemption also that happened the day before of about 42,000 crore. So banks were flush with cash, and chances are they will remain that way because there's another bond redemption on June 12th of about 11,000 crore. Plus, in July, there is a bond redemption of about 43,000 crore. So all this money will keep banks in a tidy position. As well, traditionally, June, July, August are months when money returns to the banking system. From September, October onwards, again, the festival season starts and people withdraw money from the banking system. So anyway, cash returns, as well as we know, government spending has started, and you know, money will move out when advance taxes are paid in June 15. But RBI has already announced an OMO. So the previous open market purchases of bonds also are now beginning to show impact. The arithmetic shows that liquidity crunch will not be felt. Banks will be in surplus mode probably all through June and July.
All right, Lata, thanks a lot for that. In fact, on the very note, we spoke with A. Prasanna as well, who mirrors the sentiment. He says that he expects the liquidity surplus, which could continue through the month of June.
In addition to the redemption, of course, there has been month-end spending by the government also, as the government pays out salaries and other payments which are due. That apart, seasonally we are entering a period where the currency in circulation actually comes back into the system, whereas usually April and May is when the currency kind of drains out of the system, and June, July is when we see it coming back into the system. So that should also be favorable for liquidity. On top of that, of course, what RBI can do both in terms of FX operations and, like you mentioned, open market operations. So they've already announced one OMO for the month of June for 15,000 crore. So even as we are entering into a seasonally good period for liquidity, RBI is also trying to do its bit by infusing more liquidity. So our sense is that through June, at least in the first half of June, the surplus situation will continue. Of course, subsequent to that, there are tax payments due to the government, both in terms of advance tax and GST. So that time, again, the government surplus will start building. And then again, in the month end, again, they will start spending. So by and large, if you take on an average over June and July, we do think the system should remain in surplus on most days.
All right, with that we move on. All eyes will be on the RBI policy tomorrow after two successive rate cuts in February and April. What can we expect this time? With the growth hitting its lowest level in the last 5 years and the chorus for a rate cut getting louder, majority of the market participants polled by cnbc TV 18 for a survey expect a rate cut. Ritu Singh is here with the highlights of that survey and the key findings of that survey.
The Monetary Policy Committee of the RBI is expected to cut repo rates for the third time in a row, bringing it to 5.75% according to our poll. Now, while on one hand, low growth and soft inflation will build the case for a rate cut, Uncertainty about oil prices, weak El Nino conditions, slow transmission of rate cuts by banks could hold the RBI's hand, but of course the majority seems to think that the case for a rate cut is stronger. Therefore, 70% of the respondents to our poll expect the repo rate to be cut by 0.25% in this policy. 10% are even expecting a 35 basis point rate cut from the governor. For the full financial year FY20, majority of the respondents expect a 50 basis point cut. Some even expect up to 100 basis points cut. Now, on the macro picture, 70% of our respondents again expect RBI to lower the GDP growth forecast for FY20, and accordingly 70% of our respondents also expect the GDP growth forecast for the first half of FY20 to be lowered in tandem. However, for the second half of this year, GDP forecast of 7.3 to 7.4% growth may be left unchanged. Do remember, the growth had slowed down to 5-year low in the Jan-March quarter of 2019, and that may well be one of the factors that pushed the MPC to go for a rate cut. The other big factor, of course, will be inflation, and the majority of our respondents expect the CPI forecast for the first half of FY20 to be left unchanged. As for the second half of FY20, half of the respondents expect that 3.5 to 3.8% CPI projection to also be left unchanged. Do remember, CPI edged up in April to 2.92%, but it continues to remain well below RBI's comfort zone of 4%. Another factor that could again support a rate cut by the MPC. However, the economists polled by cnbc TV 18 do not expect RBI to change its stance from neutral to accommodative just yet. And lastly, the statement of the policy itself, that is expected to be far more dovish